Monetary Policy with Opinionated Markets. This paper was NBER working paper series, and it was officially published on the American Economic Review. This paper is written by Ricardo J. Caballero and Alp Simsek. And this version is provided by the National Bureau of Economic Research. Abstract. We build a model in which the Fed and the market disagree about future aggregate demand. The market anticipates monetary policy mistakes, which affect current demand and induce the Fed to partially accommodate the market's view. The Fed expects to implement its view gradually. Announcements that reveal an unexpected change in the Fed's belief provide a micro foundation for monetary policy shocks. Tantrum shocks arise when the market misinterprets the Fed's belief and overreact to its announcement. Uncertainty about tantrums motivates further gradualism and communication. Finally, disagreements affect the market expected inflation and induce a policy trade-off similar to cost-push shocks. Introduction. The Fed and the financial markets often disagree about future interest rates. Figure 1 documents this observation by plotting the evolution of the federal funds rate over time, along with predicted paths. The dotted line plot the Fed's predictions. Either the Fed staff's assumption for the Green Book or the former member's medium dot forecast. The solid lines plot the forward interest rates that reflect the financial market's predictions. Each color matched pair of lines plots data from the same FOMC meeting. Similar disagreements are observed in other countries where central banks publish their expected interest rate paths. For example, Sweden, Norway, and New Zealand. See UBIT 2015, Culture 2021. Empirical evidence suggests these disagreements are at least partially driven by different opinions about economic activity. There is also plenty of anecdotal evidence that market participants often have their own opinions and disagree with the Fed about appropriate interest rate policy. These opinionated disagreements are a source of concern for the Fed, as they suggest that the market might perceive the Fed's policy decisions as mistakes. In this paper, we build a model in which the Fed and the market have opinionated disagreement about future aggregate demand. We obtain several positive and normative results. First, we show that this type of disagreements can explain the differences in interest rate predictions between the Fed and the market depicted in Figure 1. Second, we find that the Fed's optimal interest rate policy partially reflects the market's view. The Fed expects to implement its view gradually. It waits for the data to change the market's belief toward the Fed's belief before fully implementing its view. Third, we provide a micro foundation for monetary policy shocks. Policy announcements that reveal a surprise change in the Fed's belief affect financial markets like textbook policy shocks, even though they are optimal under the Fed's belief. Fourth, we show that more damaging tantrum shocks arise when the market misinterprets the Fed's belief and overreacts to its announcement. Uncertainty about tangent justifies prudential gradualism and communication policies. Finally, we show that disagreements affect the market expected inflation and induce a policy trade-off similar to cost-push shocks. Our model is a variant of the canonical New Keynesian model, like Clarida, Galli, and Gerler 1999 and Galli 2015. Nominal prices are fully sticky in our baseline setup and partially sticky in an extension. There is a representative household, the market, that makes consumption saving and labor supply decisions. The Fed sets the risk-free interest rate in an attempt to insulate the economy from aggregate demand shocks that affect spending without changing current potential output. Due to policy lags, the Fed cannot fully stabilize the output gap, output relative to potential. Instead, the Fed target a zero output gap on average according to the Fed's belief. The central insight of our paper is that the market considers the Fed's interest rate decisions that do not match the market belief to be mistakes. We use quotes to remind the reader that these are mistakes under the market's belief, not under the Fed's belief on the objective belief. To capture this insight, we assume the market and the Fed can have opinionated belief disagreement about aggregate demand shocks. In our baseline setup, agents know each other's beliefs and agree to disagree. Agents also learn over time as they observe new public signals and data. But learning is gradual and disagreements can persist. Persistent disagreements imply that the market anticipates monetary policy mistakes that affect forward interest rate, economic activity, and the Fed's optimal interest rate policy. Concretely, suppose the Fed becomes more optimistic than the market about a permanent component of demand. Since the Fed is optimistic about demand, it raises the interest rate to stabilize the output gap. However, since the market doesn't share the Fed's optimism, it considers the interest rate hike to be a mistake and expects the output gap to be negative. Moreover, since the disagreements disappear gradually, the market expects mistakenly high interest rates in future periods as well. The forward interest rates immediately increase and put downward pressure on current economic activity. Therefore, even though the Fed is optimistic about aggregate demand, it does not need to raise the current interest rate by much to stabilize the output gap under its belief. In equilibrium, the Fed raises the interest rate by a relatively small amount, which, together with the increase in the forward rates, reduces aggregate demand just enough to counteract the increase in the Fed's optimism. The Fed also expects to continue raising rates over time, since it expects the data to support its view and persuade the market to move closer to its view, a form of expected gradualism in monetary policy. Conversely, when the market becomes more optimistic than the Fed about demand, the market thinks the Fed sets mistakenly low interest rates in the current and future periods. This puts upward pressure on current economic activity. Therefore, even though the Fed's belief did not change, it hikes the interest rate to some extent so that there is initial overshooting. The Fed also expects to gradually undo this overshooting as the data supports its view and reduce the market optimism. Our first set of results formalizes the logic in these examples. We show that the Fed's optimal interest rate reflects a weighted average of the Fed's belief and the market's belief. That is, the Fed cannot set interest rates by focusing only on its own view of aggregate demand. It also puts some weight on the market view, even though it disagree with the market. What this weighted average policy rule, together with agents' learning, also explains the observed differences between the markets and the Fed's expectations for future interest rates. Agents agree on how the policy rule will respond to beliefs, but they disagree over what future beliefs will be. For sufficiently distant horizons, the market's expected rates reflect the market's current belief, because the market thinks the Fed will learn from data and come to the market's belief. Conversely, the Fed thinks the market will learn from data and it will be able to set future interest rates reflecting its current belief. Our second set of results provides a micro foundation for textbook monetary policy shocks, which are typically modeled as ad hoc random variations around a policy rule. In our model, beliefs and disagreements change over time because agents heterogeneously interpret new public signals. The idiosyncratic part of the Fed's belief is then naturally revealed to the market at discrete times, so that via a policy announcement or a communication. This revelation leads to micro-funded monetary policy shocks that we call Fed belief surprises. These surprises affect financial markets like textbook policy shocks. For instance, after an interest rate hike that reveal a more optimistic Fed than the market expected, the forward interest rates increase and the market expected output gap decrease. The market revises its view of monetary policy mistakes in the discretion of higher interest rates. However, unlike textbook shocks, Fed belief surprises are optimal under the Fed's belief. Therefore, their implications for subsequent economic outcomes are subtle and depend on the data generating process. For instance, if the market belief is correct, the same as the data generating process, then a positive interest rate shock driven by a Fed belief surprise is on average followed by negative output gaps. However, if the Fed's belief is correct, then the interest rate shock is on average followed by zero output gaps, the Fed's target, despite the market's negative reaction. Overall, the Fed believes surprises are relatively benign policy shocks, at least under the Fed's belief. Policy shocks are potentially more damaging if the Fed is uncertain about how the market will react to its announcements. Suppose the market can interpret an interest rate hike as an increase in either long-term or short-term Fed optimism, and the Fed does not know how the market will interpret the rate hike. This allows for tantrum shocks in which the forward rates overreact to the Fed's rate hike relative to what is optimal under the Fed's belief. After a tantrum shock, the Fed misses its output gap target even under its own belief. In practice, the Fed is likely to be aware of contexts where tantrum shock are more likely. We show that the fear for tantrum shocks induces the Fed to act more gradually than in our baseline setting. We also show that communication between the Fed and the market is useful. Not to persuade the market is opinionated, but to reduce the likelihood of a tantrum shock. In the final part of the paper, we extend the model to allow for partial price flexibility, which gives rise to a standard Newcasian Phillips curve. This extension strengthens our mechanism in the sense that the Fed accommodates the market's belief even more than with fully sticky prices. For optimal policy purpose, disagreements closely resemble the cost push shocks in the textbook Newcasian model. Consider the earlier example with an optimistic Fed in which the market expects the Fed to set high interest rates and induce negative output gaps. With partial flexible prices, the market also expects disinflation, which via the Phillips curve reduce current inflation. The Fed is then pushed to set a lower interest rate than before, closer to the market's pessimistic belief, to induce a positive output gap under its belief and fight the disinflationary pressure. In fact, the divine coincidence breaks down and the Fed faces a trade-off between stabilizing the current inflation and the current output gap. The rest of the paper is organized as follows. After discussing the relative literature, we start in section 2 by documenting facts about interest rate disagreements between professional forecasters and the Fed that motivate our modeling ingredients. Section 3 introduces our general environments, describes the belief structure, and derives the equilibrium conditions. Section 4 shows how disagreements affect optimal interest rate policy and together with learning explain the gap between the Fed's and the market expected interest rates. Section 5 introduces the market uncertainty about the Fed's belief and derives our results about micro-funded monetary policy shocks. Section 6 introduces the Fed's uncertainty about the market's reaction to its announcements and derives our results from tantrum shocks. Section 7 analyzes the extension with partial price flexibility. Section 8 provides final remarks. The online appendix contains the omitted derivations and proofs, as well as the details of our empirical analysis.